Let's be completely honest for a second. Nobody wakes up excited to rebalance their investment portfolio. It feels like cleaning out your garage. It's boring, it takes time, and it's easy to put off until next weekend. But as an investment professional with over 20 years of experience, I can tell you a secret. This one boring task is exactly how the world's most successful investors protect their money and maximize their gains. Hello everyone, my name is Rakesh from EPK Capital. At EPK Capital, we build wealth for generations. Today, we are going to talk about the biggest mistakes investors make when they ignore portfolio rebalancing and exactly how you can avoid them. Think of rebalancing like driving a car. When you start, you align your steering wheel to stay in your lane. But as you drive, the road curves, the wind pushes you, and if you don't gently adjust the steering wheel, you'll end up in a ditch. Rebalancing is simply steering your investments back to your original goal. Whether you live in India or abroad, and whether you are investing a portion of your monthly salary or managing millions, the rules of the game change. Let's break this down into two main categories: resident Indians and non-resident Indians, or NRIs. Let's start with resident Indians. The Indian market has been on an incredible growth journey, but this rapid growth actually creates a massive hidden risk in your portfolio. For everyday retail investors in India, the biggest mistake I see is falling in love with your winning investments. Let's say you started with a safe, balanced plan. 50% in stocks, 50% in safe bonds or fixed deposits. Over a few years, your stocks, especially mid and small cap mutual funds, perform brilliantly. Suddenly, stocks make up 80% of your portfolio. You might think, great, I'm making money. But what you've actually done is take on a huge amount of extra risk without realizing it. If the stock market drops, your entire life savings takes a massive hit. How do you avoid this? Don't let your emotions drive your money. Set a calendar reminder once a year. If your stocks have grown way past your original target, sell a little bit of the winners and use that money to buy the safer investments that have fallen behind. Now let's talk about high net worth individuals, or HNIs, living in India. The mistake here is what I call product clutter. Over the years, HNIs are pitched hundreds of ideas. They have PMS, direct stocks, AIFs, and real estate. They think they are deeply diversified. But when we look under the hood, we often find that all these different managers are buying the exact same top 20 stocks. This means you are paying high fees for the illusion of safety. The fix for HNIs is consolidation and big picture rebalancing. You need to look at your entire net worth from a bird's eye view. Instead of just rebalancing within one account, rebalance across your entire life. If your real estate values have skyrocketed, it might be time to pull back and increase your liquid, fixed income assets. Keep it clean, keep it visible, and make sure your tax advisor and wealth manager are talking to each other before you make a move. Now, let's shift our focus to non-resident Indians. Managing wealth across borders is a completely different ballgame. For retail NRI investors, the most common mistake is ignoring currency depreciation. Many NRIs send all their savings back to India. Over the long term, the Indian rupee naturally depreciates against these stronger currencies. So, a 12% return in India might actually feel like 6% in dollar terms. To avoid this trap, retail NRIs must rebalance geographically. Do not just balance stocks and bonds. Balance your home country with your host country. A great rule of thumb is to align your investments with where you plan to retire. Significant portion of your wealth needs to be in global assets. Finally, let's look at NRI high net worth individuals. The stakes here are incredibly high. The absolute biggest mistake is rebalancing without looking at tax traps. The moment you sell to rebalance, you might trigger a massive, unexpected tax bill in your host country. Foreign tax laws can be punitive toward Indian mutual funds. The solution here is structural rebalancing. Before you move a single dollar or rupee, you need a tax-efficient wrapper. This might mean using global holding companies, trusts, or specific offshore platforms that allow you to rebalance without triggering immediate tax events. So, what does all of this mean for you? Rebalancing is not about trying to predict the future or timing the market. It is simply about managing your risk. I promised you an action item for today, and here it is. Sometime this week, sit down and do a quick portfolio audit. I guarantee you there has been a drift. If you aren't quite sure how to fix it without triggering high taxes, You don't have to figure it out alone. Reach out to us at EPK Capital. Let's have a conversation. At EPK Capital, we build wealth for generations. Thank you for your time, stay disciplined, and I look forward to speaking with you soon.